Ever wondered what mutual funds are and how they work? Well, let's break it down. Imagine you're at a party and you don't know what to bring. So, you pool in money with your friends and buy an assortment of snacks. That's how mutual funds work. You, along with other investors, pool your money together to buy a variety of stocks, bonds, or other types of assets. This collection of assets is what we call a portfolio. Now, you don't need to be a financial whiz to invest in mutual funds. They are managed by professionals known as fund managers who decide what to buy or sell within the fund's portfolio based on thorough market research. Therefore, mutual funds offer a way for those with limited knowledge time to still invest and potentially grow their money. Now that you know what mutual funds are, let's understand how they work. Mutual funds pool money from many investors and use it to buy a diverse range of stocks, bonds, or other securities. This is where the term diversification comes into play. By investing in a variety of assets, mutual funds mitigate the risk of loss. A strategy that's rather hard to achieve for individual investors due to lack of knowledge, skills, and resources. That's where fund managers come into role. These financial experts make decisions about how to allocate the pooled investments, aiming to generate the highest possible returns. However, this comes with a cost. Investors are required to pay an annual fee for the management of their funds. It is a percentage of the total investment made in the fund. This is called the expense ratio. For instance, if you invest rupees 10,000 in a fund which has an expense ratio of 2%, then it means that you need to pay rupees 200 to the fund house to manage your money. The higher the fund expense ratio, the lower the returns will be. The expense ratio typically includes three major costs. The first being management fees. Mutual fund investments require a high level of research, knowledge, and experience to generate returns. This management fee is a compensation for the fund manager's expertise. The second cost is administrative cost. The administrative costs are the expenses of running the fund. This would include keeping records, customer support and service, information emails, and any other way of communication. Lastly, we have the 12(1)(b) distribution fees. Many mutual funds collect the 12(1)(b) distribution fee for advertising and promotional purposes. Usually they charge their shareholders to market and promote the fund to the investors. These three fees combined are equal to the percentage of assets deducted from the fund. There is a variety of mutual funds available, each with its own set of characteristics and risk levels. Let's delve into some of them. First up, there are equity funds. These primarily invest in stocks and are ideal for those with a high-risk appetite, seeking long-term capital growth. Then we have debt funds, which invest in fixed income securities. They are generally considered lower risk and provide stable returns, making them suitable for conservative investors. Next are index funds, a form of passive investing that aim to replicate the performance of a specific index, such as the Nifty 50 index. Lastly, we have hybrid funds, which combine both equity and debt investments, offering a balance between risk and return. Each type of fund carries its own level of risk, from market volatility to interest rate fluctuations. The next question on your mind might be, how are returns on mutual funds calculated? Well, let's break it down. Returns on mutual funds are typically calculated using a formula that considers the net asset value, or NAV, of the fund. This NAV is nothing but the market value of the securities the fund has invested in. It is the per share price of the mutual fund. For example, if the market value of securities of a mutual fund scheme is rupees 200 lakh and the mutual fund has issued 10 lakh units of rupees 10 each to the investors, then the NAV per unit of the fund is rupees 20. That is 200 lakh divided by 10 lakh. Since market value of securities changes every day, NAV of a scheme also varies on day-to-day basis. Let's take an example to calculate returns. Imagine you invested in a mutual fund with a NAV of 10 rupees per unit. After 1 year, the NAV rises to 15 rupees per unit. The return on your investment is the change in the NAV, expressed as a percentage of the initial NAV. So in this case, your return would be a 50% increase. Remember, while this is a simplified example, in reality, factors such as the fund's expenses and any dividends or distributions would also impact your returns. And that's how you calculate the returns on your mutual fund investments. Ready to start investing in mutual funds? Here's how you can do it in India. There are several modes of investment to choose from. The first one is lump sum investment, where you invest a large amount at once. It's a great option if you have a substantial amount of savings and want to invest it all at once. Next, we have the systematic investment plan, or SIP. With SIP, you can invest a fixed amount regularly, be it weekly, monthly, or quarterly. It's an excellent choice for those who want to invest bit by bit over time. Then there's the Systematic Transfer Plan, or STP. This allows you to transfer and invest from one fund to another. And lastly, the Systematic Withdrawal Plan, or SWP, lets you withdraw a fixed amount from your fund at regular intervals. Each mode has its own benefits and suits different types of investors. That's all for today. Stay tuned for our next video, where we will explain what is SIP and why is it important and the different ways to invest in an SIP. Don't forget to subscribe.